Hey, Joe, this is John Paulson asking a question. How are you?
Great.
Joe, it's very exciting to see the focus on Thryv. You really created something very meaningful here and necessary for the small business. And, you're up to version 5.0 now, and I'm sure more to come. When I look at the valuation, as exciting it is, we all know software companies trade at much higher multiples than we do, but by combining the two companies together, the whole company only trades at 2.2 times EBITDA. Now, it's hard to find, pure plays, but when I look at HubSpot, which is, a public SaaS company and not necessarily the same as Thryv, but they trade, a 15 billion market cap. They trade at, almost 17 times 20 sales and 200 times EBITDA. Thryv trades at only 0.6 times sales. It would seem that, Thryv really, by combining it with a business that's declining, low 20% a year, I don't think you'll ever get the valuation that Thryv deserves. So my question is, why not spin off the Thryv, the SaaS business? Because that can have a valuation that's multiples greater than the total valuation for Thryv today, and the marketing service will probably continue to trade at the same valuation, more or less 2 to 2.5 times cash flow.
John, your feed dropped off there. If you come back, feel free to interrupt me. I'm going to go ahead and respond to your question and your comment, and then like I said, if you get reconnected, just interrupt me if you have more question to add to that. I just want to say that the whole company today is valued, based on the cash it's generating. It's just a kind of a DCF model, and it's a gloomy one at that, and a very pessimistic one, and that's okay. I mean, we're pretty patient about this. We're not playing this game for November of 2020, or even this quarter, or even this season. We're thinking much longer term. We think there's a really very big opportunity here. This will be the platform that small businesses around the world use to run their companies. We've got a big, marketplace app store where lots of tools are busy, jumping on our API and writing in order to connect with Thryv. And Thryv really, John, you back? And Thryv really is a platform business. It's not just a little tool or a little niche thing. It's very big. And so, we're thinking much bigger about where this goes. And think of a rocket taking off. It stays attached to the gantry, for a while as it's coming up. And, there probably is a time out in the future, 4 years from now, where it may make sense to separate these businesses. But the two businesses benefit tremendously at the moment from the attachment. And we're not, overly concerned that we haven't crystallized that future value today. We're just focused on building an excellent platform for small businesses, and the valuation will come. And, some of the conversations we've had with a few of the, investment analysts and so on, they start talking about some of the parts where perhaps somebody will begin to view the hidden gem that's sitting inside of this big company and say, gosh, in fact, a direct quote, one of them said, your $100+ million SaaS business is like a mini unicorn. It's worth more than the entire company is. And, I'm not an expert on valuations. I'm an expert on trying to help small businesses. So that's what I'm focused on. I do think that there will be a re-rating as Thryv continues to, grow and accelerate. I mean, if I'm really honest, we grew so fast, we had to kind of digest for a minute there. We had several quarters where Thryv didn't grow. as we were kind of changing strategies, moving up market, we sold a lot of customers we probably shouldn't have sold initially that we didn't know any better. And we had to kind of work those off. But now we've got a very tight ideal client profile. We know exactly who we should sell. We're disciplined about selling those people. We're finding they onboard and use the software. And we think we can really build on this base. And we see it in our engagement. We see it in the number of people using the software, logging in every day. We see it in payment volumes. We see it in automated marketing automation campaigns that are going out every day. We see we've got a tool that allows us to watch that. So in summary, you're right that there probably is an opportunity down the line to separate these businesses, but my prediction is that we will benefit a lot over the next few years by them being together, and that there will be an expansion of people will begin to kind of see through that, and there'll be a little bit of a sum of the parts type valuation that will likely occur. And if not, then that might push us to do it sooner. But I think that will happen, and only time will tell.
Yeah, Joe, can you hear me now?
Yeah, you're right there,
Hello?
strong and clear. Yeah.
Okay, good. Yeah, no, I agree with you. That Thryv is very exciting, but I don't think you'll ever get the valuation. Maybe some pickup as long as Thryv is a part of a business that's declining at 20%. And the thing is, as one of your advisors said, the value of Thryv could be as much as the value of the SaaS business of Thryv could be equal to the total value of Thryv. The total value of Thryv is around, the $1 billion with only 300 or so in equity. I mean, you could potentially get a 2, 3 times, 4 times increase in the equity value by spinning off Thryv by spinning off the SaaS business without affecting the total value of the Thryv today. And the benefit is, you say, you're in a very competitive market, and there's a lot of people with enormous resources, and they can tap the equity markets to raise money very easily to fund the growth. And by not having that tool and being at a disadvantage in terms of the cost of capital, it's like competing against HubSpot and others with your hands tied behind your back. So I think separating the two, and I'm not saying separate today, but, it should be something on the, not 4 years, something in the, perhaps the next year or year time frame. I think it will give you a lot greater flexibility and a much greater cost of capital to pursue the growth that you're targeting.
Well, I mean, you make a really good point, and I respect your experience and perspective. You also have been a great backer of this thing too, so to be fair. We'll take that and think about that. John, we are running the company today as though we're going to split it tomorrow. We're running the marketing services business and the SaaS business as, we're tracking them that way, we're running them that way, we're thinking about them, accounting for them that way, and we're really working toward an eventual separation because we do see that problem. And you may be correct that it will make sense for us to do that at some point. And I'm going to take very strongly your advice and suggestion, and perhaps we should do it sooner than we were thinking.